The stock market is currently closed, and the last reported closing price for Applied Digital Corp, under the ticker APLD, on the NASDAQ was $32.54 as of the close on Tuesday, October 21, 2025, which represented a minus 9.36% drop, or a decline of $3.36 from the prior close. That massive daily swing of nearly 10% is a powerful move, especially after the stock's parabolic run over the last few months, and it's a jarring number to see. This stock is trading on volatile sentiment, and while the surface narrative is all about the massive AI and high-performance computing contract wins, that sharp dip gives us the immediate, crucial insight. The market's true focus is now shifting from announcement to execution risk and the implications of internal financial signals. Everyone is rightfully captivated by the multi-billion-dollar, multi-year contracts that Applied Digital has been signing with hyperscalers. Deals like the approximately $5 billion 15-year lease just announced today with an investment-grade hyperscaler for 200 megawatts at their Polaris Forge 2 campus, bringing their total leased capacity with major players to 600 megawatts. This kind of headline figure creates an undeniable expectation of immense future value, positioning them as one of the fastest builders of specialized AI infrastructure. But the reality check, the thing that caused that slide yesterday, is a combination of two things: profit-taking after an extraordinary run, and more importantly, a red flag from insider sales. The general belief has been that APLD is a pure-play infrastructure proxy for the AI boom, similar in sentiment to a stock like NVIDIA stock, which everyone sees as the primary hardware beneficiary. The sheer size and duration of these announced leases, we're talking about billions of dollars in contracted revenue over 15 years, validate the company's strategic shift away from its crypto mining roots and towards high-density, liquid-cooled data centers purpose-built for AI's demanding power requirements. This narrative has propelled the stock to astronomical year-to-date returns, far outpacing many established players in the data center space, and has generated a strong buy recommendation consensus from analysts, with price targets often pushing into the $40+ range. Investors are largely looking at the total potential contract value and the sheer speed of their deployment in North Dakota, believing the biggest hurdle has been cleared: securing the demand. However, the deeper reality is that these contracts are not instantly recognized revenue. They are a massive backlog, dependent entirely on successful, timely, and cost-efficient construction and commissioning, which is not a trivial matter. Construction risk is real, especially for complex, high-power density facilities aiming for aggressive power usage effectiveness metrics like the promised 1.18. The market is starting to price in not just the glory of the announcement, but the inevitable difficulty of the execution, a challenge that requires massive capital deployment, which is partially being addressed by the partnership with Macquarie Asset Management. Then we have the insider activity, the substantial sale of shares by the CEO and CFO, reported recently. While executives have valid personal reasons to sell stock, when a stock is running hot and a company is consistently raising capital, significant sales from the very top leadership can be interpreted by the market, fairly or not, as a lack of conviction in the immediate upward trajectory. This is the tension between expectation and reality that's driving the volatility. The expectation is that management is fully vested in the upside. The reality is they've taken millions of dollars off the table. This is the nuanced angle that separates the cautious optimism from the speculative fervor, and it's likely a major driver for the heavy volume, near 10% sell-off we saw yesterday. Looking at the recent trading pattern, the sharp decline follows a period of extreme momentum. The stock had essentially climbed over 40% in a single month, leading up to the most recent contract announcements and the strong Q1 fiscal 2026 earnings report on October 9th. That earnings report was technically a beat, showing $64.2 million in revenue, an 84% year-over-year jump, largely driven by tenant fit-out services for the HPC segment, and a narrower-than-expected adjusted loss per share. This positive earnings surprise initially fueled the spike, leading to multiple analyst price target increases. However, the report also underscored the rising costs of revenue and significant increases in SG&A expenses, largely due to stock-based compensation, which widens the net loss, something the street tends to gloss over when the growth story is this compelling, but which institutional investment managers will ultimately have to square with their financials. The increase in the Series G convertible preferred stock floor price from $22 to $34, which came just before this volatility, was an attempt to better align the financing with the elevated stock price, a clear signal from the company. But these complex financing mechanics also introduce a layer of uncertainty for the average retail investor using platforms like Robinhood for quick trading, or even those seeking straightforward online investment via an intelligent portfolio. The sheer trading volume during both the upswings and the recent pullback suggests a high level of institutional trading. While the total institutional ownership remains high, the last reporting period saw mixed activity. 184 institutions increased positions, while 130 decreased them, with a few large holders dramatically reducing their stake, showing a clear division of opinion among large Fidelity investments and hedge funds. This push and pull is what creates the extreme volatility and is a defining characteristic of high-growth, pre-profit companies with massive contract backlogs. Short interest is another key metric here, with off-exchange short volume ratios consistently running high, often about 40%, indicating that a significant portion of the daily trading is still betting against the company's ability to execute, another major source of the stock's daily price swings. What exactly does Applied Digital do? At its core, the company is an owner and operator of purpose-built data center facilities, providing a massive, reliable power and infrastructure foundation for compute-intensive customers. They operate primarily in two segments: the data center hosting business and the new, higher-growth HPC hosting business. The former provides energized space, often to crypto mining customers, which was the original foundation of the company. The latter, and the focus of the market's attention, is the development and leasing of high-power density data centers, the AI factories, that are specifically designed for the next generation of computing workloads, namely AI and high-performance computing. Their key selling point, as evidenced by the CoreWeave and the new hyperscaler leases at their North Dakota campuses, Polaris Forge 1 and 2, is their ability to rapidly deploy massive capacity, specifically liquid-cooled infrastructure, in areas with abundant, low-cost power. This is a direct play on the constrained supply of high-spec data center capacity needed to power NVIDIA's H100 GPU chips and similar accelerators. The business model is shifting from simply being a landlord for power to a critical strategic partner in the AI supply chain, securing long-term, high-value fixed-revenue leases that provide incredible revenue visibility, hence the billion-dollar headlines and the sudden jump in market capitalization. However, historical performance before this pivot showed a company struggling with profitability, generating significant net losses and negative cash flow from operations, which is common for companies in an aggressive build-out phase, but which serves as a constant anchor on its valuation and a reminder of the capital intensity of its business. The challenge now is maintaining liquidity to fund the massive capital expenditures required to build out the contracted capacity. The $5 billion partnership with Macquarie is designed to help with the financing for Polaris Forge 2, which is critical. This approach, leveraging large capital partners to reduce the equity burden, is a sign of a maturing strategy, but it introduces a new layer of financial complexity that retail investors engaging in self-investing through platforms like Fidelity or interactive brokers might overlook when seeing a headline price target. The future outlook for Applied Digital is an absolute high-stakes scenario defined by a race against the clock. The company has successfully secured massive demand. The catalyst pipeline is clear, successfully bringing online the 100 megawatts at Polaris Forge 1 in the fourth calendar quarter of 2025, followed by the phased 200 megawatts at Polaris Forge 2 in 2026 and 2027. Each successful milestone where a new facility comes online and revenue starts flowing from a hyperscaler lease should provide a powerful upward pressure on the stock price as it de-risks the execution component. The greatest opportunity lies in the fact that the new hyperscaler partner has a first right of refusal on the remaining 800 megawatts of capacity at Polaris Forge 2, meaning the total contracted revenue could potentially skyrocket even further, potentially securing the full 1 gigawatt capacity of the campus. This kind of potential expansion is what keeps the